Wednesday's hot CPI print flashing warning signals to investors that inflation is in danger of reversing course, a possible trend that could be furthered by the threat of new tariff policies from the Trump administration. Nouriel Roubini is a professor emeritus of economics at New York University Stern School of Business, and he joins us now on set with more. Thank you so much for being here this morning. I'm tempted to call you Dr. Doom, your gloomy title, but you moved away from that title last fall. You had a little bit more of an optimistic view on the economy and the future of the country. Where do you sit with that view and that title today, given the inflation data and the current administration?
Well, I would say that even before Trump won the election, the economy was closer to a no landing zone rather than a soft landing. And certainly the risk of a real hard landing recession had diminished significantly. By no landing, I mean a situation where growth remains above potential and inflation remains above target, as opposed to a soft landing where you go towards potential growth and inflation at target. And the economy is hot. Inflation has remained sticky. Last year, growth was 2.8% when potential is estimated by the Fed at 1.8. This year, many people expected already to be 2.5, 2.6, still above potential, unemployment low. So it's a hot economy, hot market. And that's well before the Trump administration introduces its policies.
Right.
Some of those policies over time could increase growth and reduce inflation. Things like deregulation, low taxes, more fossil fuel production, overall pro-business economic activity, the technological innovation of the tech sector, DOGE. There are sets of policies that could reduce growth and increase inflation. And those policies have more of an impact in the short run on growth and inflation, while the stuff that's going to increase growth and reduce inflation takes a long time. It's going to take us a year before the impact of the regulation on more fossil production is going to reduce inflation. So what are the things that can go wrong? Tariffs, protectionism, economic war with our friends, allies, and also with China. That's inflation, reduces growth. Secondly, migration, if it's net zero or net negative because of mass deportation, that's going to reduce growth and increase inflation. If we make the tax cuts permanent, we don't fund them, and likely we're not going to fund them, the deficit will go higher. That overheats the economy, pushes bond yields higher. Trump is already attacking the Fed, and that could unhinge inflation expectation if the Fed is considered less independent. And eventually, they want to weaken the dollar because they believe that the strong dollar has led to deindustrialization, American carnage. So you have all these factors that are actually reducing growth and increasing inflation. I think the net of it will be that the net between the positive and negatives on growth are going to be a bit of a wash, some good stuff, some bad stuff. But the net on inflation is going to be that the stuff that reduces inflation is going to take 3-4 years at best, while the stuff that could increase inflation, specifically in the short run, trade policy and tariffs, migration policy, and large deficits are going to have an impact on inflation. And already we see that the economy is strong and inflation is even higher based on the CPI today, even before those concerns about inflationary policies are going to be becoming actual policies. So I'm not surprised that the Fed says we're in no rush to cut rates. The market is now pricing maybe one cut December, I think could be zero. In a scenario in which core inflation goes higher this year, you cannot rule out that the Fed is going to increase policy rates rather than reduce them this year.
So how hot could inflation then potentially be this year?
I would say that, in the Fed forecast, core PCE that by the end of last year was about 2.8, was supposed to fall by the end of this year around 2.3 or so.
Is that too optimistic, though, given some of those risks that you just laid out?
Yeah, and they're going to revise. Their forecasts were not yet including the impact of the new Trump policies. That's why they're being cautious. I would say there is a risk that core PCE this year is more like 2.6, 2.7. In that case, maybe the Fed stays on hold, but if it's going to go above 2.8 and closer to 3%, then the Fed has to increase policy rates this year, and that will put it on a collision course with Trump.
Do you think that's likely?
Trump has already started to criticize the Fed for the last few weeks, even based on the CPI today. He says they should be cutting rates right now when the Fed is saying, no, we're not going to cut them. Rightly so, the markets are expecting barely one cut as of this morning, December. I think it's more likely the Fed stays on hold, and there's a risk of, Powell is not going to say this year in his testimony we're going to raise rates, but going to be pushed on the question under which condition you could not just stay on hold, but also increase policy rates. And there are some conditions, and there's a meaningful increase of core PC inflation that would lead to that. And that will be, even before there's an increase in rates, even just keeping them on hold is going to put him on a collision course with Trump, because Trump wants to cut rates now. So we're already seeing those tensions, and they're going to build up.
How concerned does that make you for the strength of the consumer under the weight of that inflation, especially given what we heard from Powell yesterday, that he does think the neutral rate has gotten higher than folks maybe previously anticipated?
Well, on one side, you'd say the reason why inflation is high is because the economy is strong and has been strong. So it means that consumption, 2/3 of GDP, has been strong. Within the consumer, of course, those that are in the top 50% distribution of income are doing well. The bottom 30, kind of paycheck by check, has been struggling. And for those people, of course, Fed funds rate, the current level with mortgage rates at 7, auto loans, student loans, credit cards, personal loans, is a stress, but it's a divided consumer between, people refer to it as the K-shaped recovery. Those who are better off are going to be better off, and those who are in the bottom are struggling. So it's a division, but overall, the economy is doing well. Consumption is doing well. CapEx is going well because of technological innovation. Fiscal stimulus is still ongoing. Net exports, that is trade, is still weak. And residential investment is weak also because interest rates are high.
Nouriel, I'm curious because one of your posts caught my attention last month, or was it earlier this month? Everything's blurring together. But on the heels of the DeepSeek news, just about 2 weeks ago.
Yeah.
And you seemed a bit more optimistic just in terms of maybe the bullishness that could potentially unlock when you talk about AI adoption.
Yeah.
I'm curious just how you square that then with this overall risk that we are seeing when it comes to rates, when it comes to the inflationary picture, and kind of how that then sets up equities for this year.
Well, there are some positives in the economy, and one of the positives, a part of his policies, is lucky because it's not just AI, machine learning, robotic, automation, quantum, green tech, ag tech, fintech. There are 10 industries of the future. In my view, are going to increase the potential growth of the US by the end of the decade to about 3%. And the fact that actually growth is already well above 1.8, and we don't see strong inflation is a signal that the potential is rising. So that's a medium-term view. In the short term, as I said, there's a bunch of policy that instead can stoke inflation and can reduce growth. So there's a tension between the good stuff, including technology, and the stuff is going to be negative. So in the short term, we are in this no landing zone, and actually technology is going to increase growth as well. The labor market is tight, and if we have restriction to migration, that's going to make it even tighter. But for the stock market, I would say after 2 years of 20% returns on S&P, valuations are high in terms of P ratio. Earnings growth is going to be moderate. An economy is growing okay, and inflation is around 3. So on a fundamental basis, probably you should have single-digit returns on equities, not double digits, say between 5 to 7% this year overall. What can make things worse than that is if we have policies that on trade, on fiscal deficits, on migration push bond yield higher. The 5-year this morning went up 10 basis points on the inflation report, is now closer to 5.7 than to 5.5. Then if you had a 10-year yield that goes to say 5%, then you get a correction in equities. And that correction in equities and higher bond yield implies higher mortgage rates and other things that imply the economy starts to weaken and the stock market has to correct. So in the short term, I would say if we're lucky and the policies are moderate, you get single-digit returns this year. If some of the bad policy increase inflation and push the Fed to stay on hold and materialize and 10 years go to 5%, the stock market for the year is flat and it could have a correction in the next few months. But over the medium term, I would say that probably being overweight equities, and within equities tech, and within tech even the Mag 7, in spite of the noise from DeepSeek, I mean, if what the DeepSeek has done is correct, and of course they underestimate how much they spend, how much they stole the NVIDIA CPU, but it's something as a step function that increases total factor productivity growth for the US and globally. So medium term actually is a positive aggregate supply shock for the world and for the US that benefits everybody, should lead to higher equity prices because growth is going to be greater. Short run, of course, you have to ask yourself which one of the hyperscalers do better or worse and whatever not. But on net, they're going to do well in spite of DeepSeek. DeepSeek, in my view, is an evolution. It's not a revolution. It's not as if the business model of OpenAI is broken. Actually, without OpenAI, DeepSeek could not even exist. They free road on all the knowledge. They distill the models and so on and so on. So overall, over time, technology innovation is positive for US, positive for the world. It's positive for growth. It reduces inflation. It's good for the stock market, but that's a medium-term view. If you take a medium-term view.
I want to follow up on what you said about a potential correction. If we do see that over the course of this year, are investors safe with AI stocks, or are they safe with only specific stocks that you think can benefit from the expansion of access to AI presented by an opportunity like DeepSeek?
Well, if bond yields go higher, what happened, for example, in 2022 when inflation was rising, 10-year yields went from 1 to 3.5. Long duration equities, and tech stocks are long duration because the dividends are further in the future, are more sensitive. So in 2022, S&P fell 15%, NASDAQ fell 30%. The growth and tech stocks that were smaller fell more than 30%, 40, 50. So they're more sensitive to movements in interest rates just because of the nature of the long duration assets. And that could happen again in a correction. That correction probably stuff like that is going to correct more this year. But then if you take the long view, I would say if there is a significant correction in tech or Mag 7, at the bottom of that one, that's a buying opportunity, because if you look at the horizon of 5-10 years, those are going to be the winners. There's an old economy and there's a new economy, and the new economy is represented by technology. And over the medium term, as an investor, if you see even a significant correction, it's a bit like, there was an internet bubble in 2000, then went bust, the NASDAQ fell 60%. But if you had, bought at the bottom, you had done a fortune.
Right.
Even if you bought before the peak of the bubble, in spite of the correction, by now, 30 years later, you are still well better off than you were before. So depends on what's your horizon. It's very hard to time the market. What's the peak? What's the bottom? When it's going to be correction? How much? And so on. So I would say I would be overweight over the medium term on a variety of hyperscalers, Mag 7, tech stocks of various sorts, and so on, and not worry about the short-term dips.
So Nouriel, just given the fact that the short term is so tough to predict at this point, looking then out over the next 4 years, I'm curious. From Trump's first month in office, there certainly has been a lot of flip-flopping. There's been the sowing, certainly, of uncertainty that's been rattling businesses just a bit. Overall, from what you've seen, would you say the Trump administration's positive for business or negative?
I would say that over time, with lots of volatility and noise, may be positive, because I described you 5 or 6 reasons why growth will be greater and inflation lower. 5, 6 reasons why it could be lower growth and higher inflation. But there are 4 important guardrails and constraints to preventing bad policy from becoming really bad. We'll have some tariffs. The question is not tariff yes or no, but whether it's 5%, 10, 15, 20, 50 on China. And the 4 guardrails are: 1, market discipline. If policies lead to higher inflation, then bond yields go higher, the stock market corrects, it's going to be punished. And it cares about both the stock market and the bond market. Actually, the bond market more so, because everything that is sensitive to interest rates depends on long rates, and is based as mortgages, credit card, auto loans, student loans, personal loans. So that's one constraint. The second constraint is the Fed. The Fed is independent. The Fed has already told us. We wait and see his policies. His policies are going to be inflationary. We're going to raise rates, and that's going to be punished and guardrail him. The third one is that while some of his national security and other advisors are a bit cuckoo, the Pete Hexets and Kash Patels of the world, the 4 key economic advisors of Trump know both the economy and the markets: Scott Bessent, Steve Miran, Howard Lutnick, Kevin Hassett. The exception that is weird, very protectionist, is Peter Navarro, but he's an exception. So they're going to tell him, President, if you follow certain policy, bond yield will be higher, stock market falls, the economy is going to weaken, and you're going to be punished. And if he does steal the things because he shoots from the hip, he wakes up in the middle of the weekend and decides on a tariff without even consulting Scott Bessent, then the market corrects on the Monday, and then they go and tell him, you see, I told you so. Now, what do you want to do? You want to double down on the bad policies, or you want to instead do a course correction? And we saw he announced the tariffs on Mexico and Canada, the market corrects, and then an hour later he's on the phone with the president and the prime minister, and then he decides, okay, I'm going to postpone it by a month. So ideally on tariffs, you could explain what is happening as he's trying to escalate as a way of de-escalating, to extract some concession and so on. If that's the case, then tariffs are going to be smaller, inflation is not going to be so high. If instead really goes down hard, then the market is going to punish him. And the fourth constraint, apart from market discipline, bond vigilantes, good advisors, and the Fed independence, he has a small majority in Congress. Some of the stuff on trade have to be legislated. They cannot do them by secretary action. Many people in the Congress don't want the high tariffs. It's going to hurt their own state, their own constituency, and so on. So there are these four guardrails. And I would say the most important is market discipline. The former advisor of Bill Clinton, Jim Carville, was famous for saying two things. One, it's the economy stupid, so you have to keep the ball on the economy. And the second thing he said is that in my next life, I want to be reborn as a bond vigilante, so I can go around and beat up the policymaker I don't like. Because you can control your party, GOP, you can control Congress, you can control the judges, you can control the Supreme Court, you can control even the media because you're controlling X, but you cannot control the investors. And the investors are going to punish you if your policies are bad for growth and increase inflation. So I think that's going to be the most powerful constraint. Market discipline was working in emerging markets. The last few years I worked even in advanced economies like Greece, Italy, UK, France, and you name it. Even in the US, that is the global reserve currency, bond yields, as you saw today, they went up by 10 basis points. And if those policies become even more inflation, they go to 5%. They could go much above the 5%, and that's going to really punish him. So the bond vigilantes are the main constraint to bad policies.
Final 30 seconds. I want to end where I started with you. You were called Dr. Doom. You moved away from that title. What title would you give yourself today for the next year?
I've always said that I'm Dr. Realist. I'm not Dr. Doom. There are some upsides. There are some downsides. As I pointed out, some of the policy can go in the right direction. Some can go in the wrong direction. So you have to be, as an investor, leave aside your preferences, ideological biases, and figure out not how the world should be, but how it's likely to be, and based on that one to make your investment decision. So Dr. Realist, I would say.
Dr. Realist. All right, Nouriel, always great to have you. Thanks so much for taking the time to join us here on set.
Great pleasure being with you today. Thank you.